Stop watching the price on your screen and assuming you understand the market. What you see in New York right now is not the real silver market. It is a reflection, a delayed echo of something much larger unfolding elsewhere. Silver trading at the mid-70s in the United States is not a sign of balance or stability. It is a sign of disconnect. The real market signal is not coming from COMEX or the headlines flashing on financial news channels. It is coming from the physical market in China, where silver is already trading near $80 an ounce when all costs, premiums, and delivery realities are accounted for. This is not a normal price difference. In a functioning global commodities market, prices between major hubs rarely diverge by more than a few cents. Transportation costs, hedging, and arbitrage usually keep everything tightly aligned. A $5 gap is not inefficiency. It is a fracture. It means the system designed to equalize prices has stopped working. And when that system fails, price does not move gradually, it resets violently. What is happening now is not speculation. It is a liquidity crisis. The type of crisis that does not begin with panic selling, but with silent hoarding. The type that starts when buyers are willing to pay almost any price, and sellers simply disappear. In Shanghai, physical silver is not being traded as an investment vehicle. It is being treated as a strategic input. Solar manufacturers, battery producers, electronics firms, and state-linked buyers are paying whatever it takes to secure supply before year-end. These are not traders chasing charts. These are procurement officers trying to keep factories running in 2026. For them, the cost of silver is irrelevant compared to the cost of production shutdowns. This is why the Shanghai Gold Exchange price matters more than the COMEX ticker. Shanghai trades physical metal. COMEX trades promises. In times of surplus, paper dominates. In times of shortage, physical dictates reality. We have crossed that threshold. The timing matters. Late December is traditionally the most dangerous period in financial markets because liquidity evaporates. Trading desks are understaffed. Risk managers are absent. Market makers widen spreads or step back entirely. This is known as Ghost Week. When large orders hit during this period, prices do not adjust smoothly. They jump. That is exactly what we are seeing now. Silver moving multiple dollars in a single session is not enthusiasm. It is vacuum behavior. Buyers are stepping into an empty room. There is no resistance because the sellers are gone. Vaults are depleted. Refiners are closed for holidays. Dealers are unwilling to sell inventory they cannot replace. The visible market still shows numbers, but the underlying supply is missing. This is confirmed by retail reality. Attempt to buy physical silver in size right now, and you will discover the truth immediately. Products are out of stock, delayed into late January, or priced far above spot. American Silver Eagles selling near $90 are not evidence of greed. They are evidence of replacement risk. Dealers cannot hedge in an unstable futures market, and they cannot guarantee restocking at current prices. The rational response is to raise premiums or stop selling altogether. This is how liquidity crises reveal themselves, not through crashes, but through absence. And when the ability to transact disappears, the quoted price becomes meaningless. The arbitrage gap between New York and Shanghai is the engine driving this entire move. A $5 spread is not sustainable. Capital flows toward higher returns, and metal flows toward higher bids. Every ounce purchased cheaply in the West and sold at a premium in the East accelerates the drain on Western inventories. This creates a feedback loop. As inventories shrink, prices must rise to slow demand or attract supply. But supply is not responding. Silver supply is structurally constrained. Roughly 70% of global silver production comes as a byproduct of other metals like copper, lead, and zinc. Miners cannot simply increase silver output because silver prices rise. If base metal demand does not justify expansion, silver supply remains flat regardless of price. This is why higher prices are not solving the shortage. At the same time, demand is accelerating. Solar installations in China alone now consume hundreds of millions of ounces annually. Electric vehicles require significantly more silver than combustion engines. Grid infrastructure, defense systems, and electronics all depend on silver's unmatched conductivity. There is no substitute at scale. Demand is not price sensitive in these applications. It is necessity-driven. This creates the most dangerous possible market structure, inelastic supply meeting inelastic demand. In such a system, price becomes the only release valve, and price does not move linearly. Adding fuel to this situation is the options market. The $75 level represents a massive concentration of call options sold by banks. As price approaches that level, dealers move into negative gamma territory. This forces them to buy futures as price rises, amplifying upward momentum. In a thin market, this dynamic can trigger rapid, self-reinforcing moves. Once the threshold breaks, price acceleration is mechanical, not emotional. This is why the $75-$80 zone matters so much. It is not psychological, it is structural. Behind all of this sits a broader macro reality. The global financial system is saturated with debt. Sovereign bonds, once considered risk-free, are now losing credibility. Inflation erodes purchasing power faster than yields compensate. Capital is fleeing paper promises in search of tangible assets. Gold has already sent this signal by reaching historic highs. Silver is now catching up, not as an alternative, but as leveraged exposure to the same monetary breakdown. The gold to silver ratio still sits near 60 to 1. Historically, that ratio collapses during monetary stress. Even a return to the 2011 average implies dramatically higher silver prices at current gold levels. This is why institutional money is rotating. Silver is mispriced relative to gold, and markets are correcting that imbalance. What we are witnessing is not a rally, it is repricing. A transition from a suppressed, paper-dominated market to a physically constrained one. These transitions are always violent because the old price was never real. As we approach the end of the year, this pressure intensifies. Funds prepare for January allocations. Industrial buyers front-load inventory. Arbitrage drains remaining stock. Liquidity disappears further. All the conditions that suppress volatility during the year reverse simultaneously. This is why the move feels unstable, because it is. But instability does not mean weakness, it means change. And this change has only just begun. To understand why the silver market is behaving the way it is right now, you have to stop thinking like a trader and start thinking like an industrial buyer. Traders react to price. Industrial users react to availability. And right now, availability is the single biggest problem in the global silver market. Price is only the symptom. The real disease is supply insecurity. Across China, procurement departments are no longer negotiating for next month's delivery. They are negotiating for next year's survival. Solar manufacturers, battery producers, semiconductor firms, and state-linked infrastructure projects are all operating under the same realization. If they do not secure silver today, there is no guarantee it will be available tomorrow at any price. This is the shift that changes everything. For decades, global manufacturing operated on a just-in-time model. Inventory was considered waste. Capital tied up in warehouses was seen as inefficiency. Companies trusted global supply chains to deliver raw materials exactly when needed. That trust has collapsed. The pandemic exposed the fragility of logistics. Energy shocks exposed geopolitical risk. And now the Shanghai Premium is exposing the fragility of metal supply itself. Silver is not just another commodity. It is a critical input with no scalable substitute. It is required for high-efficiency solar cells, EV power systems, 5G infrastructure, advanced electronics, medical devices, and defense technology. When silver is missing, production stops. When production stops, revenue collapses. No CFO is willing to risk that outcome to save a few dollars per ounce. This is why Chinese buyers are paying close to $80 an ounce without hesitation. To them, the premium is not a cost. It is insurance. Paying an extra $5 today protects billions of dollars in downstream revenue. That logic makes demand effectively unlimited, and when demand becomes unlimited in a market with fixed supply, price becomes irrelevant until the system breaks. The most important detail most investors miss is where the silver is going. It is not sitting on exchange inventories. It is not being traded back and forth. It is disappearing into bonded warehouses, free trade zones, and private industrial stockpiles. Once silver enters these locations, it vanishes from public reporting. It is no longer available to stabilize markets. It becomes strategic inventory. This creates a false sense of security in Western data. Analysts look at reported exchange stocks and conclude that supply is adequate. They are wrong. They are only looking at what is visible, not what is locked away. The real inventory is dark inventory, and it is growing rapidly in Asia. At the same time, Western vaults are bleeding metal. The arbitrage gap forces silver to flow east. Every bar shipped reduces the ability of Western exchanges to deliver against futures contracts. This increases counterparty risk. And as counterparty risk rises, confidence collapses. Confidence is the foundation of paper markets. Futures contracts only work if participants believe delivery is possible. When that belief cracks, the market ceases to function as intended. We are seeing early signs of that now. Backwardation is appearing. Spot prices in certain markets are exceeding futures prices. This is not normal. It is a distress signal. Backwardation means the market is screaming for immediate delivery. It means buyers do not trust future promises. They want the metal now. This is the exact condition that destroys paper-based pricing systems. Futures markets were designed for surplus environments. They break under shortage. This is why bullion dealers are freezing sales or dramatically increasing premiums. It is not coordinated manipulation. It is survival. Dealers rely on hedging to manage risk. In an unstable market with thin liquidity, hedging becomes expensive or impossible. If a dealer cannot hedge, selling inventory becomes gambling. Rational businesses stop gambling. This behavior cascades. As dealers stop selling, retail buyers are forced to pay higher prices or wait. As retail supply dries up, panic increases. Panic increases demand. Demand drains remaining supply faster. The cycle accelerates. Meanwhile, Miners are not rushing to save the market. In fact, many are doing the opposite. Mining executives are acutely aware of the structural deficit. They know supply cannot respond quickly. They also see geopolitical risk rising, taxation threats increasing, and energy costs climbing. Selling aggressively into a rising market makes no strategic sense. Holding inventory provides leverage. Some miners are quietly withholding supply, waiting for clearer price discovery. Others are negotiating off-market contracts directly with industrial buyers, bypassing exchanges entirely. These deals never show up in public data. They remove supply permanently from the visible market. This tightens conditions further. The byproduct nature of silver production amplifies this effect. Because most silver comes from base metal mining, higher silver prices do not automatically increase output. If copper or zinc demand is weak, silver supply remains constrained regardless of price. This breaks the classic economic assumption that higher prices cure shortages. At the macro level, the supply crisis is unfolding against a backdrop of monetary instability. Global debt levels are unsustainable. Governments are forced to monetize deficits. Inflation is no longer transitory. Bond markets are cracking under the weight of rising yields and falling trust. Capital is searching for assets that cannot be printed. Gold has already confirmed this shift. Silver is following, but with greater volatility due to its smaller market size. The entire investable silver market is tiny compared to global capital flows. Even a small reallocation from bonds or equities overwhelms available supply. This is where the January effect becomes critical. As the calendar flips, institutional capital resets. Pension funds, sovereign funds, and asset managers rebalance portfolios. Performance chasing is real, especially after a year where silver has dramatically outperformed traditional assets. Even a fractional allocation shift represents billions of dollars. Those billions will hit a market that is already dry. This is why the coming weeks matter more than the past decade. We are transitioning from accumulation to recognition, from quiet hoarding to visible repricing, from suppression to exposure. And once markets recognize that physical silver is scarce, not theoretically scarce, but functionally unavailable, behavior changes permanently. Sellers demand higher prices. Buyers accept them. Volatility becomes the norm. This is not the end of the move. It is the middle. What happens next is not a mystery. It is not speculation. It is math colliding with human behavior at the worst possible moment for the financial system. As the calendar flips toward January, the silver market is entering a phase where timing, liquidity, and psychology align in a way that historically produces violent outcomes. This is where the real move begins, not where it ends. January is not just another month. It is the reset point for global capital. Budgets reopen. Allocations reset. Performance is judged. And assets that performed well in the previous year attract capital regardless of valuation. This is known as the January effect. And in normal markets, it produces modest inflows. In broken markets, it produces explosions. Silver is walking into January with momentum, structural shortages, a broken arbitrage mechanism, and visible price divergence between East and West. That combination is extremely rare. In fact, it has only occurred a handful of times in modern financial history, and every time it ended with a repricing event rather than a gradual adjustment. The most important thing to understand is that institutional money does not wait for pullbacks. Pension funds, endowments, and sovereign allocators deploy capital based on quarterly and annual mandates, not intraday charts. When silver finishes the year as one of the top performing assets, it forces inclusion. Not because managers believe in silver, but because they cannot justify zero exposure to their committees. Even a tiny allocation shift has outsized consequences. If a global pension system with hundreds of billions under management decides to allocate just 0.1% to silver, that is more demand than the entire annual mine supply available to investors. And that demand does not negotiate price. It accepts it. This is where the illusion of liquidity collapses completely. Paper markets are built on the assumption that sellers will always appear. In January, that assumption fails. The sellers are gone. The metal is gone. The only thing left is price escalation. At the same time, hedge funds that remained short into year-end face a nightmare scenario. January brings new margin requirements, new risk reviews, and fresh scrutiny from compliance departments. Losses that were tolerated in December become unacceptable in January. This forces short covering at the worst possible moment, adding fuel to an already unbalanced market. This is how squeezes turn into avalanches. The gamma dynamics worsen this effect. As silver approaches and exceeds major strike levels, banks that sold call options must hedge by buying futures. The higher the price goes, the more they must buy. This creates a reflexive loop where rising prices generate additional buying pressure. In thin January liquidity, this feedback loop can push prices far beyond what fundamentals alone would suggest. But fundamentals are already extreme. Industrial demand is not slowing. Solar installations are accelerating. Electric vehicle production is expanding. Grid infrastructure upgrades are mandatory, not optional. Silver consumption is rising into a supply ceiling that cannot move quickly. Even at elevated prices, demand destruction does not occur because silver ACE, cost contribution to finished products, remains small relative to its functional importance. This is why the old logic of high prices cure high prices no longer applies. Silver is not copper. It is not oil. It is not consumed based on discretionary demand. It is consumed based on necessity. Meanwhile, Western exchanges face an existential problem. As physical inventory drains, their ability to maintain credibility erodes. Every delay, every cash settlement, every premium spike reinforces the perception that paper silver is not equivalent to real silver. Once that perception takes hold, participation collapses. Markets do not need to default to fail. They only need to lose trust. When trust is lost, price becomes irrelevant. Access becomes everything. This is the phase where private deals dominate, where metals trade hands quietly at premiums that never appear on screens, and where official prices lag reality by days or weeks. This is already happening. The Shanghai premium is not an anomaly. It is the new reference point. Asia is setting the price because Asia is taking delivery. The West is discovering that price leadership follows possession, not volume. This represents a structural shift in global market power. For decades, Western financial centers dictated commodity prices through derivatives. That era depended on surplus. Surplus is gone. Deficit has arrived. In deficit markets, the holder of physical supply sets the terms. That is why attempts to suppress silver now backfire. Any paper-driven price smash simply widens the arbitrage gap, accelerating the outflow of metal. Lower prices do not stabilize the market. They destabilize it faster. The system is trapped. This brings us to the psychological dimension, which may be the most important factor of all. As prices rise rapidly, investors experience vertigo. Long-term holders begin to doubt themselves. They question whether they should take profits. They fear giving gains back. This is precisely the moment when most people sell too early. But selling silver for fiat in a currency debasing environment is not profit-taking. It is asset swapping into a weaker unit of account. If silver rises because currencies are failing, then converting back into currency does not preserve purchasing power. It only delays loss. This is why sophisticated capital does not exit into cash. It exits into other real assets, land, businesses, infrastructure, or gold, using the gold to silver ratio as the exchange mechanism. That ratio remains historically elevated. Even after the recent rally, silver remains undervalued relative to gold by long-term standards. This tells us the move is incomplete. It tells us silver is still in catch-up mode. In previous cycles, the most explosive gains in silver occurred after gold had already made its move and institutional recognition followed. We are at that exact juncture now. The final risk is not price volatility, it is counterparty failure. In a liquidity crisis, contracts fail before prices stabilize. Investors who rely on paper claims may discover they own exposure, not metal. This is why ownership structure matters more than entry price. As January unfolds, expect increased volatility, wider spreads, and more frequent market disruptions. These are not signs of weakness. They are signs of stress. Stress precedes repricing. By the time headlines catch up, the opportunity window will have narrowed. This is how all major commodity repricings occur. Quiet accumulation, sudden recognition, violent adjustment. Silver is now between stages 2 and 3. The January effect is not a guarantee of upside, but in a structurally broken market with confirmed shortages, it acts as an accelerant. And accelerants do not create fire. They only reveal how much fuel was already there. The fuel is everywhere. What happens next is not about charts. It is about flow. And the flow is one way. This is not the end of the story. It is the beginning of the phase where outcomes stop being debated and start being enforced by reality. The price will move until behavior changes. Behavior will not change until access is restored. Access will not be restored without much higher prices. That is the loop. And once loops like this begin, they rarely stop where anyone expects them to.